It is wild to think that a tiny change in, like, a single sentence recently saved massive financial institutions from millions of dollars in potential compliance errors.
Oh, yeah. Millions. It's incredible.
Right. I mean, the difference between a crippling regulatory fine and a perfectly executed risk model wasn't a faster supercomputer
Mm.
or some brand new algorithm.
No, and it wasn't a room full of math geniuses running Monte Carlo simulations either.
Exactly. It was literally a comma, a specific domain name, and this rather alarming realization that the smartest artificial intelligence in the world is, well, it's actually incredibly easy to confuse.
It really is.
Welcome to this deep dive. If you are joining us, you are likely looking for the mechanisms behind the headlines, the actual how and why of the tools reshaping our world right now.
Because it's moving so fast,
Exactly.
right? You really need to look under the hood.
Definitely. So today, we are opening up a highly technical, completely fascinating research article by Satyadhar Joshi. It's titled, Leveraging Prompt Engineering to Enhance Financial Market Integrity and Risk Management.
It is a phenomenal piece of research, honestly, because it challenges this fundamental assumption most of us hold about artificial intelligence.
What assumption is that?
Well, we tend to view large language models as these infallible, autonomous oracles, where you just type a vague question into a search bar and receive a perfect financial strategy.
Right, like a magic 8-ball that went to Harvard.
Exactly. But Joshi's paper strips away that illusion entirely.
It really does. The mission for our deep dive today is to unpack how prompt engineering, which is the literal architecture of how we structure a command to an AI, is essentially the only thing standing between precise financial risk management and total systemic chaos.
Total chaos, yeah.
We are going to explore how typing the right sentence is becoming just as critical to market integrity as the mathematical models themselves. Okay, let's unpack this.
Let's do it.
Before we can really scrutinize the way we structure our commands, we need to understand the machinery we are commanding, right? And Joshi's research doesn't just analyze AI in a vacuum.
No, not at all. It pits the absolute titans of the industry against each other in real-world financial stress tests.
Which I love. It's like a tech heavyweight bout.
It is. The researchers set up this head-to-head showdown. They evaluated the performance of OpenAI's ChatGPT-4 against Google's Gemini.
Specifically looking at Gemini versions 1.5 and 2.0, right?
Yeah, exactly. And the baseline task wasn't writing a marketing email or summarizing a meeting. They tasked these models with generating actionable, highly technical insights for credit and market risk analysis.
So we're talking about parsing dense regulatory frameworks and extracting precise data points for financial forecasting. Heavy stuff.
Very heavy. Now, when you put two tech giants like OpenAI and Google in a ring together, the assumption is usually that they will trade blows and come out relatively tied.
Yeah, you'd think they'd be maybe a percentage point or two apart.
Right. But the data from Joshi's paper shows a massive divergence. ChatGPT-4 actually outperformed Google Gemini by over 30% in generating accurate financial insights.
Wow, over 30%. I mean, a 30% gap in accuracy isn't just a rounding error.
Not even close.
In the financial sector, a gap like that translates to billions of dollars in misallocated capital or, unseen portfolio risk.
It is a staggering performance gap. And the researchers also measured the evolution within a single model family, which was super interesting.
Oh, like comparing ChatGPT to its older versions.
Exactly. They found that ChatGPT-4 was 20% more effective than its direct predecessor, version 3, in these specific risk analysis tasks.
That's a huge jump between generations.
It really is. And where version 4 genuinely separated itself from both its older iteration and from Gemini was in its ability to align with strict regulatory frameworks.
Okay, wait. I want to push back on that 30% performance gap between OpenAI and Google for a second.
Sure.
Because you have two companies with functionally infinite resources, right?
Yeah.
Massive server farms, brilliant engineers. Why is there such a massive discrepancy in the output? Is it just raw computational power?
Yeah. What's fascinating here is that is the core of the issue, and it reveals a lot about how these models actually function.
How so?
Well, in a highly complex domain like credit risk analysis, raw computational power is actually secondary. The primary metric of success is contextual alignment.
Contextual alignment, meaning what exactly?
Think about it this way. Financial risk is essentially a mathematical problem that is completely encased in a legal problem, which is then further complicated by macroeconomic theory.
Oh, that's a great way to put it. Layers of complexity.
Right, so a model can process data at light speed, but if it loses its grip on the specific regulatory guardrails of the U.S. financial system midway through generating an output, the entire analysis becomes a liability.
It's just doing fast math on the wrong rules.
Exactly. And ChatGPT-4 demonstrated a vastly superior baseline architecture for holding on to that highly specific context over long, complex instructions.
So it's not just about finding the right numbers. It's about remembering the rules of the game while it calculates those numbers.
You nailed it. It's like upgrading not just from a bicycle to a car, but from driving a manual transmission to a self-driving
Oh,
car.
I like that analogy. But even with a self-driving car, right, the tool's power is entirely dependent on the driver's skill, or in this case, the prompt engineering.
Absolutely. Even a model that excels at contextual alignment will fail spectacularly if the human operating it provides a flawed or generic instruction.
Which perfectly sets up the experiments Joshi ran to document what a flawed instruction actually looks like. Because we need to see the bad driving.
Yes. The researchers set out to generate 50 questions regarding credit risk. Specifically, questions designed to test a bank's proprietary auto and home loan default models.
So essentially, they wanted the AI to act as a rigorous internal auditor to see if the bank's lending models were sound.
Right, and to do that, the human operator needs to tell the AI where to find the rules for that audit.
And here is where the failure occurred, which is just wild to me. In an initial prompt, the user gave the AI an instruction that sounds, completely logical.
On the surface, yeah.
They told the AI to exclusively use US.gov websites to source the regulatory requirements for these loan models.
Which seems clear enough.
But the AI derailed. It provided generic, largely unhelpful audit questions, and far worse, it actually pulled data from a .nl domain.
Yeah, .nl.
It grabbed regulations from the Netherlands instead of the United States.
A total failure of the primary constraint.
Here is my confusion, though. If this multi-billion-dollar large language model is sophisticated enough to process complex risk variables and beat its competitors by 30%, why on earth does it need so much handholding?
It's a fair question.
Right. Shouldn't a system that advanced intuitively understand that when I ask for U.S. government data to audit an American home loan, I do not want an analysis of European banking regulations from a Netherlands website?
This raises an important question, and honestly, that frustration is universal among first-time AI users in finance.
I can imagine.
It stems from a fundamental misunderstanding of the technology. We anthropomorphize the AI. We assume it possesses human common sense and understands our intent.
Because it talks to us like a human.
Right, but an LLM is probabilistic, not psychic. It does not know what you want. It just predicts the statistically most likely sequence of words based on its training data.
Wait, so if I give it a vague prompt, it basically just wanders off toward whatever data is most dense?
Exactly. Think of the AI's vast training data as this massive statistical gravity well.
Okay, gravity well.
Yeah. If your prompt is brief or lacks rigid parameters, the AI's attention gets pulled toward the most massive, frequently cited clusters of information in its neural network.
Oh, I see.
So global banking regulations, like the Basel Accords in Europe, are massively cited in highly dense data clusters.
So when the AI sees loan default models and regulatory requirements, the statistical gravity of those European papers just pulls the model off course.
Exactly. It overrides your weak command to use US.gov sites. The model doesn't realize it made a mistake. It just followed the strongest mathematical probability.
That makes perfect sense. The prompt isn't a search query. It is a set of constraints designed to fight off the gravitational pull of all that irrelevant data.
That is the exact right way to think about it.
So how did the researchers actually fix the prompt to anchor the AI to the U.S. regulations?
They had to abandon generic queries entirely and construct a highly rigid domain-specific parameter box.
What did that look like?
They modified the prompt to explicitly say, analyze .gov websites for regulatory requirements specific to auto loans and house loan defaults. Generate 50 precise and domain-specific questions in CSV format that assess model performance, regulatory adherence, and potential biases.
Okay, wow. Let's break down why that specific sentence structure worked where the other one failed. It seems like they aren't just telling it what to read, they're dictating the exact architecture of the answer.
Yes. They are dictating 4 distinct pillars. First, the explicit source limitation. Only .dev websites related to auto and house defaults.
Right.
Second, the exact output volume, 50 precise questions. Third, the format, a CSV file.
Which is interesting. Why a CSV file?
Because it removes the AI's tendency to write conversational filler and forces a structured, data-ready output.
Ah, clever. No, sure, here's some questions, just the data.
Exactly. And fourth, the analytical lens. The model must assess performance, adherence, and bias.
So by explicitly locking down those 4 pillars, the prompt engineer removed the AI's probabilistic freedom.
Precisely. The model is forced to operate exclusively within that tiny, highly specific context window, eliminating the Netherlands hallucination entirely. And the paper found that this kind of optimized prompt engineering reduces error rates by approximately 20%.
20% fewer errors just by phrasing the question like a rigid set of rules.
Yep.
Okay, so we have established how to build a rigid parameter box for a relatively static query like a credit risk audit. But an individual auto loan is a fixed asset.
True.
How does this hyper-specific prompting strategy hold up when you introduce the absolute chaos of macroeconomic trends? Because the paper moves from static credit risk into market risk next.
It does, specifically looking at how to predict fluctuating interest rates. And market risk is a completely different beast.
Because you can't just look up a single rule.
Exactly. You are no longer looking up a rule. You are asking the AI to synthesize forward-looking projections from an ocean of conflicting economic forecasts.
That sounds like a nightmare for a probabilistic model.
It is. So to achieve this, the researchers had to abandon the single prompt method entirely. You cannot just dump a massive, complex macroeconomic query into a single text box and expect an accurate model adjustment.
So what do they do instead?
They utilized a sequential 4-prompt approach.
A sequential approach,
Yeah,
meaning they build the context window block by block.
precisely. It is about establishing a foundation before asking for analysis. In the first prompts of the sequence, they command the AI to locate specific percentages and projections regarding interest rate trends from diverse, credible macroeconomic sources.
So they are essentially telling the model, go out and synthesize the current state of the global economy and just present the raw data.
Just the facts, yes.
And the output they received from that initial extraction was remarkably precise. I remember the paper highlighting that the AI successfully synthesized data showing the Federal Reserve was projecting 2 quarter-point interest rate cuts in 2025.
Which is spot on.
Yeah, and it correctly identified the anticipated target range of 3.75% to 4.00% by the end of 2025. It even captured the longer-term projection of a 50 basis point reduction by the end of 2026.
It's impressive. But here's the thing. Identifying the Fed's projected rate cuts is really just data extraction.
Right, a traditional search engine could eventually find those numbers for you.
Exactly. Here's where it gets really interesting, though. The true value of the sequential prompting approach is revealed in the final prompt of the series.
Right. What did the final prompt ask?
The researchers essentially turn to the AI and say, now that you have established this highly accurate macroeconomic context, how should I adjust the internal parameters of my own proprietary interest rate model to reflect this new reality?
Oh, wow. This is the moment the technology shifts from being a glorified research assistant to an actual strategic partner.
Totally.
It's like having a hyperspeed financial intern who not only reads every dense Federal Reserve transcript, but formats it directly into a CSV file for your spreadsheet and then tells you exactly which dials to turn on your own model.
That is exactly what it is. The AI didn't just hand over the Federal Reserve data. It generated specific prompts that the risk managers could use to calibrate their internal machine.
Give me an example of that. What kind of calibration?
Well, it provided commands like, if inflation is projected to rise to 3.2% in 2025, how would I need to modify my model's inflation assumptions to reflect this change?
Oh, I see.
Or it offered scenarios based on GDP, suggesting, my model assumes a GDP growth rate of 2.5%. How do I adjust if external forecasts predict slower growth at 1.8%?
So by using a sequential prompt, the engineer forces the AI to act as a bridge.
Yes. The AI ingests the messy external reality of the global market in steps 1 through 3, and in step 4, it translates that reality into the exact mathematical adjustments required for a bank's internal proprietary risk model.
It entirely eliminates the friction of human translation between external data and internal strategy.
It does.
I mean, if you zoom out and look at the sheer capability of that workflow, you have a tool that can instantly read thousands of pages of dense transcripts, isolate the exact basis point reductions, format them perfectly, and then strategically instruct a risk manager on how to run a sensitivity
The
analysis.
scale is hard to comprehend, honestly.
Right. When a capability like that scales across the entire global financial sector, the ripple effects have to be astronomical.
Well, they are. And the paper dedicates a significant portion of its analysis to that exact question. They did a quantitative literature review to measure the industry-wide impact.
What do the numbers look like?
The massive efficiency gains reported by early adopters are undeniable. We are looking at a 10% increase in overall asset management efficiency.
A 10% gain in asset management efficiency across a major institution is an almost unfathomable amount of recovered time and capital.
It fundamentally reshapes profit margins. Furthermore, the data cites a 15% reduction in portfolio risk through more accurate scenario modeling.
15% less risk just by asking better questions.
Yes. And when optimized prompt engineering was applied to predictive analytics, institutions saw a 30% reduction in predictive errors.
Wow.
In the transactional space, payment processing speeds increased by 18%. And fundamentally, the early adopters of this LLM automation reported a 20% overall reduction in operational costs.
Rate is massive.
Yeah.
With metrics like a 15% drop in portfolio risk and a 20% cut in operational costs, every single bank executive on the planet is going to mandate the adoption of this technology immediately.
They'd be crazy not to, financially speaking.
Right. The financial incentive is simply too massive to ignore. But whenever an industry rushes to adopt an automated technology at that scale, they tend to overlook the structural vulnerabilities.
Always.
And the paper raises a massive caution flag regarding the ethical and governance landmines embedded in this rush to automate.
If we connect this to the bigger picture, the downside data is incredibly sobering.
Hit me with the dark side.
The researchers analyzed the frequency of governance issues in financial ChatGPT applications, and they found that 35% of reported cases involved biased outputs.
Wait, 35%?
Yes. Over a third of the cases analyzed had bias baked into the AI's financial analysis. Additionally, 22% of the cases faced severe data privacy challenges.
Okay, we need to dissect that 35% bias hallucination rate. Because in finance, bias isn't just an ethical failing. It is a profound systemic risk and a massive legal liability.
Oh, regulators will tear you apart for it.
Exactly. So how does the AI generate a biased output if it is essentially just processing numbers?
It goes back to the statistical gravity well of the training data we talked about earlier.
Ah, right. The historical data.
Exactly. Financial history is, unfortunately, rife with biased lending practices, redlining, and skewed demographic models.
Which is all documented in text.
Yes. If an AI is trained on historical loan data, those historical biases are embedded in the statistical probabilities of its neural network.
That makes sense.
So if a risk manager uses a generic, unconstrained prompt to assess loan applications, the AI will naturally default to the historical patterns it recognizes, seamlessly integrating past biases into future automated decisions.
And because of the efficiency we just talked about, it can process thousands of loan applications a minute.
Yes, it happens in a flash.
So a poorly engineered prompt doesn't just create a biased decision. It scales that bias at light speed across an entire portfolio before a human ever even catches it.
Which highlights the secondary crisis the paper addresses, which is the inherent opaqueness of AI decision-making.
Opaqueness meaning it's a black box.
Exactly. When a neural network processes a million variables to deny a loan or flag a portfolio as high risk, it doesn't naturally provide an audit trail.
Right, doesn't show its work.
No, it just gives you the output. But the intricate web of statistical weights it used to arrive at that conclusion is largely hidden. And in the financial sector, you cannot simply be right.
You must be able to prove to a federal regulator why you were right.
Exactly. You have to explain the logic.
So the question for you, the listener, is, are financial institutions just building a much faster race car without bothering to invent better seatbelts?
That is the perfect analogy.
I mean, if you accelerate your operational speed by 20%, but you have the 35% chance of scaling a biased, opaque lending model, the regulatory fallout could easily erase all of your efficiency gains.
The foundational thesis of Joshi's research is that prompt engineering is the seatbelt. The constraints, the domain specificity, the sequential logic, the mandate for CSV formatting, those aren't just tips for getting a better search result. They are the governance mechanisms.
They are the guardrails keeping the race car on the track.
Yes. A hyper-specific prompt is the only way to force the AI to ignore historical biases and demand that it provides an auditable, transparent rationale for its decisions.
So prompt engineering is no longer just an experimental IT trick.
No, it is a mandatory frontline compliance skill set.
So what does this all mean? We started this deep dive looking at the chaotic, high-stakes guessing game of financial risk. What Joshi's research reveals is that the chaos can absolutely be tamed, but not by letting a massive AI model run wild with our data.
Not at all.
The ultimate takeaway is that the precision of human language now dictates the integrity of the automated market.
That's beautifully said.
If you ask a lazy, unconstrained question, the probabilistic nature of the model will deliver a dangerous, biased, or utterly irrelevant answer.
Like the Netherlands website.
Right. But if you engineer a hyper-specific, legally bound, sequentially built prompt, you unlock a 30% reduction in errors, you bridge the gap between macroeconomics and internal models, and you secure the safety of your portfolio.
Prompt engineering really is the new bedrock of financial risk management.
It is.
It is a complete paradigm shift for the industry. And, if we carry this logic forward, it leaves us with a truly fascinating implication for the future of Wall Street.
Oh, what's that?
Well, for decades, the undisputed power brokers of the financial world have been the quantitative analysts, right? The quants.
Oh, sure. The mathematicians, the physicists, the programmers who could build the most complex numerical algorithms.
Exactly. The people who could manually process the hardest math. But if artificial intelligence can now handle the raw mathematics, the data extraction, and the algorithmic processing instantaneously,
Yeah.
then the competitive advantage no longer belongs to the person who can write the best math equation.
Wow.
The power dynamics of Wall Street are going to shift toward professionals with backgrounds in linguistics, philosophy, or law.
The people who actually understand semantic nuance.
Yes, the people who understand logical constraints and contextual frameworks. If advanced prompt engineering becomes the ultimate standard in finance, the most valuable person on the trading floor won't be the human calculator.
It will be the person who knows exactly how to ask the perfect question. The philosophers and the linguists taking over the algorithmic trading floors. That is an incredible thought to end on. Thank you to everyone for joining us on this deep dive. Keep questioning the information and the tools around you. And remember, the next time you're trying to predict the unpredictable, make sure you are writing the instructions very, very carefully. We'll catch you on the next one.